Let's look at how to go about selecting the best ETF of all time. It's not all about the fees. The most important thing with an ETF is the tracking error, which is the difference between the returns the index gives you and the returns the specific ETF gives you. The smaller the tracking error, the better. The tracking error is made up of things like the fees that the ETF charges, but then it also might have certain income as well that comes into the fund. So here with SWDA, which is an iShares Developed World Global ETF, it actually has a positive tracking error because for some reason, whatever else is going on within that ETF, it's generating income that more than offsets the 0.2% fee, which if you just looked at the fee alone, you might actually discount that ETF and say, well, I'll go for a cheaper one from someone else, when actually SWDA has a good long-term performance record. There's a choice between income and accumulation ETFs. With an accumulation ETF, the advantage is that all the dividends just wrap up within the product. You don't need to do anything. And if you're holding it within a SIP or an ISA, this really is the best hassle-free option, because with an income ETF, you'll manually get the cash that you've then got to reinvest, which can take time, could cost money in terms of like commission charges, and also you're forever looking at your account to see if you've got any dividend income, and that might cause you to sell something that you think is underperforming. So for the best hassle-free life, I think an accumulation ETF is for you. You can choose to hedge your ETF against a currency such as the US dollar, and there are times when it can seem to be quite sensible, such as where I've marked it with the circle, but generally you'll find that the dollar is a stronger currency than sterling, and so you don't want the extra costs associated with hedging. You can invest in a physical ETF where you own the underlying shares, or a synthetic one where you don't. With a physical ETF, there's possible income from short selling that can be made to your advantage. With a synthetic ETF, there can be certain tax advantages, but there's also a counterparty risk, specifically that the other side of the transaction maybe doesn't want to offer the product anymore, and therefore the product gets discontinued. It's important to look at the countries covered by the ETF that you're considering. Some will be all world, and they will include emerging markets. Generally, these ETFs will have higher fees. Emerging markets have underperformed over the last 10 years. You might get more volatility, and with China, there's still things like political risk going on. So maybe emerging markets is one to avoid at the moment. There's one or two ETFs that avoid the UK, and with the UK, the strongest sectors such as technology are underrepresented, and because value investing has been out of favour for a long time, things that avoid UK might have slightly better performance, but we can't guarantee this going into the future. Similarly, ETFs that just look at the US will have had very good performance over the last 5 years compared to their global equivalents. Whether or not this will continue is up for debate, but the strongest technology companies have emerged from within the US because partly it's got the English language, it's got strong universities to support tech. So I'm quite divided as to whether I'd go for a global fund or a US fund. What I would look at is the volatility adjusted performance of US versus global, and use that to decide whether going global is actually beneficial for my portfolio. Some ETFs are sector neutral, and that means that they mimic the sector allocation of a global tracker or maybe the S&P 500. So the problem with this approach is that the ETF is including companies purely to maintain this sector mix, even though they don't best meet the criteria that the ETF has, such as quality or paying dividends. The plus side of being sector neutral is that you won't deviate too much from the underlying index. So here we've got the key holdings of Fundsmith as well as the geographic and sector splits. So although we're not specifically looking at Fundsmith, it's interesting to see how some of the ETFs compare to this Fundsmith allocation in terms of the countries, geographies and sectors. Fundsmith is notoriously secretive about its holdings, but you can get some of them through websites such as Hedged, which will list the quarterly changes to the holdings of Fundsmith, and I've put the list of them here for you. The number of holdings that an ETF has is important, because the more holdings it has, generally the smaller the market capitalization of some of the tail end companies. But the problem is that there have been very few small cap success stories, particularly recently, and companies like Google and Tesla were never small cap, and small cap tend to suffer from things like poor management, poor access to finance, and a general lack of scale, either in terms of geographies served or their product range. So generally I'd look for a more concentrated ETF, ideally with maybe about 100 holdings. So this is how I compare funds. So I look at the 5-year compound annualized growth rate, I look at the volatility, that gives me the Sharpe ratio, but then I really prefer things like the maximum drawdown, which means that if you bought it at a high and then sold it at a low, what's the most you could have lost, the duration of that drawdown in months, and then there's a formula called returns over maximum drawdown, and I think that's a great way to rank ETFs. So you can see here that NASDAQ has a very good growth rate, the turnover maximum drawdown maybe not so great, certainly compared to S&P 500. UK small cap performing pretty badly. There's other ones like these WisdomTree Global Quality Dividends that I think are quite interesting. They've got some quite useful stats. If this interests you, I offer a portfolio coaching service. Just go to my website www.ianshadrack.com/portfolio-coaching and get in touch. The top performing open-ended investment company that's an index tracker is the L&G Global 100. It selects companies that have a diversified geographic split of assets and revenues, and we've got the top 10 holdings here. It is quite concentrated around Apple, Microsoft and Alphabet. It's also quite concentrated around the US, but because it is holding the largest 100 companies, it will always have the winners and it will always really have the cream of the crop. And even though we might be in line for a change in some of the weightings for these companies, I think that in the longer term this is quite an interesting open-ended investment company to look at. The Worldwide Quality Factor ETF, IWFQ, does have good performance. However, I'm in debt to Fund Hunter, I've got his website down there, who pointed out to me that this ETF is actually sector neutral. So although it is applying quality filters to the top 1,500 companies in the world, it's maintaining the sector split of a global tracker, and that is kind of holding back the performance of this ETF versus the unadjusted quality factor. So it's an interesting one to look at, but ideally we'd like something that doesn't have this sector neutrality. So this is WisdomTree Global Quality Dividend Growth, and it's unconstrained in terms of the sectors it looks at or the countries it looks at. It can purely apply the algorithm to the largest companies in the world and come up with its selections, which is really good. And you've got the top 10 holdings there that you can look through, and overall there's about 600 companies within this ETF. Here we've got the WisdomTree US Quality Dividend Growth, and we can see that there's higher weightings to Microsoft and Apple and a greater exposure to the information technology sector. This one has had greater performance than the global equivalent, and also it had a lower duration of drawdown because it partly benefited from the pound-dollar exchange rate, which helped it to rebound in price during 2022. This one has around 300 holdings, so it's up to you and your metrics to decide whether you prefer US to global when you look forward into the future. So this is one of the ways that I look at volatility over time. So it's the NASDAQ, where I'm comparing the price plotted monthly compared to a trend line, and I've got correlation at about 0.8, whereas other more stable funds will have a higher degree of correlation. And you can see from the peak here to the trough here, you've got quite a steep and extended drawdown that might be too much for some investors. So this is an ETF with much less volatility. There's a stronger degree of correlation between the price and the trend line. Here we've got 0.93. So this might be more acceptable for longer term investment, and fortunately we can see that the price is actually below the trend line, so at the moment it might represent a bit better value if you were to purchase. So what is right for you? Well, ultimately it just comes down to personal preference, whether you think that the US companies will continue to grow strongly, or whether you think that maybe European companies are a bit undervalued. But the most important thing is not to chase the best funds, but really to find something that is consistently good enough for your portfolio so that you'll never be disappointed with it and maybe look to sell it before it's time. So the NASDAQ can have exceptionally good performance, but it can have long periods of rather scary underperformance, so it's definitely a satellite consideration rather than a core consideration of something like a global fund or a quality dividend growth ETF. For more information on the ETFs featured in this video, check out this playlist which goes into them in much more detail.